This conference
We're
will now be
recording.
recorded.
Okay, so now we're recording. Sorry, this is small business taxation. Please, you guys chime in. Try not to give too much echo when you chime in. Let me know. I designed this to be very, here's what I hear a lot of, and to cover those things, but to allow for a relatively small meeting so you can get the most out of it. You can ask your own specific questions. Like Leah asked about how to code herself just before some of you logged in for how you classify your business. And the cheat code for that is to Google NAICS code and find what you do and kind of sort it through there, because that national coding system will apply both in Utah and on your tax return at the end of the year. So that was her question. So anyway, that's my point. So small business taxation. If you have something that you want me to specifically cover, and you can wait to the end, that's fine. If you want me to include it as part of the presentation, I'm going to let you have a minute. Just unmute yourself and let me know, and I will make sure I write it down and we include it. Okay, then we're just going to get started. Can everybody see? I don't know what you're looking at. I hope you're looking at the presentation, the whatever you call it, my PowerPoint. Can you nod, Austin? Let me know you're seeing my PowerPoints because I can see you. No, I can't see anybody else.
You need to share it again.
Okay.
Yeah, we can only see.
All right. Okay, let's try this one more time. And share screen. And that one. Okay, now can you see it?
That works.
Super. Okay, small business taxation. And this has always been my favorite quote. Albert Einstein, he just didn't have me explain it to him. He would have been like, oh, dude, income tax, it's the easiest thing ever. Okay, here we go. Here are the things that most people ask me at the beginning, and feel free to ask a question along the way. So business structure determines where the tax is paid. All of our business structure falls under these 4 categories, minus trusts and nonprofits, okay? But a trust acts like a person, so you can kind of leave that off to the side for now. But here's where all of our businesses fall. It's either a sole proprietorship, a partnership, an S corporation, or a C corporation. There really isn't opting out of those. A lot of people say, well, should I get a corporation or an LLC? It's a very, very common question. And I say, well, an LLC, the IRS has kind of thrown up their hands and said, well, we don't know what to classify this. We don't even care. Just tell us how you want to be taxed. And so if you open an LLC as a single member, by default, you'll be taxed as a sole proprietorship on your 1040. It'll just be a Schedule C on your 1040 form, on your personal income tax. If you have multiple members, by default, it will be taxed as a partnership on Form 1065. And if you file forms, you can either file an 8332, I think is what it's called, or an 8832 for being a C Corp, or you can file the 2553, and you can file as an S corporation. And the IRS will send you a letter saying, we recognize that you're going to be taxed as this type of thing. When you do that and decide to be taxed as a corporation, the IRS also requires that you follow the rules of being a corporation. So being an LLC says, well, we don't care. You don't have to have annual meetings. You don't have to worry about equal distribution. We don't care about any of that kind of stuff. If you just are going to be a partnership, you're just an LLC. It really matters if we decide to be taxed as a C corporation or an S corporation, how we operate. So then we do need to have meetings, and we do need to have our annual minutes, and we have to have our bylaws and all of those things. We need to treat ourselves as though we were a corporation if we tell the IRS that we want to be taxed as such. I hope that makes sense. Hope so. Any questions? Let me know. Next, this is the next question I get all the time. Well, how do I get money out of it? The way that we get money out of pass-through entities, sorry, I'm going to back up. No, I'm not. Everything that is on the left column is a pass-through entity or is treated as though it gets taxed on my individual income tax return. And we'll cover that on the next slide. But even though my business operates and it files its own return, it acts as though it basically passes everything through to my personal income tax return, and I get taxed at a personal level. And so it has slightly different rules than if I were a C corporation. C corporation has its own tax return and for all intents and purposes acts like a person. It's not a natural person, but it does act like a person. And so it borrows money on its own, has its own tax rate, does all of its own stuff. And so getting money out of it is a little different. So I'm going to start with a pass-through because they kind of act the same. They act very similarly. So pass-throughs. Sole proprietors, when I take money out, I can just take it as a draw. And I'm not allowed to have formal payroll. I'm not supposed to put myself on a W-2. On a partnership, the same thing applies. And that's whether I'm a partnership as an LLC, a partnership as an LLP, or just a general partnership. All partnerships fall under the same rule. I'm not supposed to have payroll to members of the partnership. If I take something out that is unequal, I take that out as a guaranteed payment. If I take money out and it's equal distributions between the two, two partners, or if I'm 33 and 33 and 33, I take my 33%, then that equal distribution, I'm just taxed on it as though I just took a regular distribution based on my percentage of the profits at the end of the year. An S corporation, I can take profit distributions, which sort of look like draws. I'm only allowed to do them equally. So if I have somebody, if I'm on a corporation, even with my wife, I am required, if she is 51% and I am 49 and we take out $1,000, she is required to take $510 of that 1,000, and I'm required to take 490, and there needs to be equal distribution. If I'm not taking equal distributions, and the IRS knows, that breaks the rules of an S corporation, and I'm no longer able to be an S corporation. There's other kinds of things that violate rules, but those are the big ones. That's one of the big ones. Is all S corporations have to have natural partners, so physical people. I'm limited to the number of shareholders to 100. I need to make sure that I have equal distributions. Those are the big things. So you can't have an LLC own your ownership in an S corp. You can't have a corporation. You can't be a foreign partner. You actually have to be a person owning S corporation interest. There's a tiny bit of wiggle room for that, but let's just go with that being the rule. And then let's move over to C corporations. C corporations are taxed, like I said, on the corporate level on Form 1120. They have their own tax rate at 21% since 2018, plus whatever the state is. They are required to have officers' wages, and they pay when they take out a distribution. That is where we get double taxed. We have a corporate tax rate, and we have the long-term capital gains rate on the income tax return. So there is that double taxation. I think it is important for the C corporation and S corporation at this point. I will say there's a lot of talk from the IRS about adequate compensation. For a C corporation, adequate compensation is not as important because they have their own tax rate, and people tend to inflate their payroll in a C corporation. Officers tend to make their payroll really, really high rather than really, really low. And in S corporations, it's the reverse. Because I can avoid being double taxed, and there are times when on my personal income tax return, I might have a really high rate. and I don't necessarily want to have payroll or other taxes, I can take my profit distributions free of any additional tax. And so the tendency of S corporation shareholders is to make their payroll really, really, really low. I hope that made sense. We'll take an example. Imagine that there's a net profit of $100,000 out of a C corporation. Well, you pay your net tax, which is your 21%. So 21,000 would go to taxes because that's your 21% of that 100,000 bucks. And if we were waiting close to the end of the year before somebody paid a bonus or anything like that, a lot of the owners will weigh out. They'll say, well, maybe we wanted to do a bonus because we have a little bit of money, but payroll taxes are close enough to the 21%. People go, well, which way is it going to work better? Is it, I'm going to pay less if I keep it in the corporation, or am I going to pay less if I move it to my personal and my top rate is 35%? So there's that issue. When it comes to an S corporation, the IRS requires that there is adequate compensation for duties done in an S corp. So let's say that I have somebody who runs a bakery, and the bakery, if a bakery manager nationwide, let's say, makes $40,000, and the net profit is still that same 100,000 bucks, let's just say, without paying officer salary. If I didn't have to pay payroll and the owner could just take the $100,000, that saves the owner self-employment tax or payroll taxes on that full 100 grand. So IRS says, wait a minute, if you're going to take any distributions out of this S corporation, the first thing that needs to come out is payroll. So in order to determine adequate compensation, we do two things. We look at the duties that you're doing and the time that you're spending doing them. So I'll go back to my bakery manager. Let's say that you run a bakery and you spend 20 hours or 25 hours a week being the manager, and then you hire assistant managers for the rest of the time, but you also do the books and you do hiring and firing and you do some other management things. Well, as the manager, you might make $40,000 a year as the bakery manager. And if you were only spending 25 hours a week doing that, we could trim that down to approximately a third or 2/3. So maybe you make $25,000, $30,000 being the bakery manager. But those other duties, the management, the hiring and firing, those kinds of things also need to have compensation added for them, depending on the time that is spent. So in that particular case, we would probably say if you made $100,000, you're probably going to want to pay between $50,000 and $60,000 in adequate compensation for being an S corporation, and that limits the S corporation shareholders in the comparative. That's not making any sense. Then your profit is only $50,000 instead of $100,000 because $50,000 went to shareholders' payroll, and you pay your income tax on the same 100 grand, but you would, or the S corporation would, have to pay payroll taxes on that $50,000. This is a good point to stop and ask if anybody has any questions. I went kind of fast and probably said words that I didn't necessarily mean, so shoot.
Just one question on the S Corp.
Yeah.
Or even on C Corp, S Corp, just thinking about businesses as they want to grow. What do you typically recommend for a business that needs capital to grow? So they're trying to accumulate business money inside the business.
Okay.
And they're saying, for example, next year I'm going to need to invest 300 grand into this, so I'm going to try and hold 300 grand in here. And for businesses that are very heavy on the investment side, what do you typically recommend for them?
That's a great question. It's like anything, it kind of depends. But if they're a software company or there's somebody that's really heavy in payroll, we tend to kind of lean towards the C corporation because it's easier to get the R&D credit that way, and it's also I'll back up. So Austin, specific to your question, there are two different ways typically of attracting money into any business. We can either sell ownership or we can sell debt. C corporations tend to do a better job with acquiring debt. They also do a better job if there's other income. This is what I mean. So I have many doctors that are clients that open a separate business. And let's say the doctor's making $500,000. Often the doctor is counseled by other people in his or her life to open an S corporation because that's the best, when in reality, for acquiring capital, for borrowing money, for the longevity of the business, for many, many reasons, it's actually a poor idea if the business is likely to be very profitable to be anything other than a C corporation. It would be better for the doctor in this case to have that all of that taxation happen outside of his or her own personal income tax return. And so that's looking at it from the tax side. From the acquiring investors side, it tends to also be easier to gather multiple investors in a C corporation. It works also really well in a partnership when there are few partners. The banks tend to do pretty well with gathering funding. You have to personally guarantee anything pretty much when you're going to get an SBA loan or any kind of small business funding when you're on the starting end. An individual is almost always going to be personally guaranteeing it. So did I answer your question, or is there a piece that I'm missing, Austin?
No, it's pretty good. It's mainly, I just have people ask me occasionally where they have, let's say, their job that they're doing, so that they're making their money, but they have some kind of business they're opening on the side, and they're saying, we just want to accumulate profits in this business over time from the actual activity of the business. So it's not equity or debt. It's just, they're selling a product and they get a kickback for it or whatever. And they want to grow it up and then use that money after they've grown it for 3 years, kind of use it as a bank account to then go buy real estate or something. And they're often curious, what is the best tax type to have actual profits in the business come in, and but just hold it to reinvest in the business in a future, some future point when they get to it. And I just find a lot of small business people in that environment where they've got a side thing, and they're literally just leaving money in it to grow and grow and grow until they get to some point of investing in something else.
All right. Then in that particular case, I would probably approach that from the tax perspective, because all things being equal, from economics, I'd rather than pay less tax. So if we use my doctor example, it would probably be better that they opened a C corporation, unless that side business was going to be property. And if it's going to be property, it's probably best that they have an LLC, as you well know, and maybe even have a parent S corporation, because also, as you know, Austin, there are some basis issues, and I don't know how deeply we want to get into that. If you're going to borrow money in an S corporation, and this is a big, big deal and a reason to choose to be taxed as a partnership or an S corporation or a C corporation. If you're going to borrow the money for the business to operate or to get started, the S corporation has a rule that does not allow the owners to get basis for third-party debt. So if the S corporation goes out and gets an SBA loan to open a manufacturing plant, the IRS says, well, all of that debt is not basis for the owners. So if the owners hadn't contributed any capital, that would limit the owner's ability to take a loss in the opening years when there usually is a loss, because they wouldn't get any basis for the borrowed money. Whereas in a partnership, in a normal LLC taxed as a partnership, those same owners would get the basis whether the loan was held in the name of the LLC or held in their own name and then just pledged to the entity. So I think to answer your question specifically, Austin, that's a two-parter. I would look at it from the tax perspective. So if we had a doctor who's getting taxed at the highest percentage and wants to have, some side hustle and just accumulate cash there, he's probably going to, or she would probably accumulate more cash being a C corporation because they're going to pay less tax and they can leave it there. And until they get to retained earnings of $250,000 or more, we don't have any reporting requirements or any additional requirements to report to the IRS why it is that we're holding funds. So that's usually the safest with the high earners. If we have low income earners or mid income earners, it's often the best to have a pass-through entity, so a partnership or an S corporation, to accumulate those same funds. And then it comes down to that basis issue. If we're borrowing money up front, if we're not borrowing any money, then it's probably better to choose an S corporation and just never take a distribution. Because if there's no distribution, there's no payroll, and we just pay income tax on the flow through and we don't worry about it. And we can have the document in the minutes of the corporation over multiple years stating, I am postponing getting payroll for this year until such time as we have the capital to take distributions, and we define it as blah, blah, blah. Which, Austin, I'm sure you well know doing this business law, but thank you for the question. But those would be the two main points that we would ask in determining what would be the best structure. I guess there's three big questions. How are you going to fund it? So is it going to be borrowed money? Is it going to be capital infusion? What are you going to do with the money? Do you want to get it out? Do you want to leave it in? And kind of what? Oh, I lost it. It'll circle back around, and I'll say something in the future. Right now, I'm going to change slides because now we're going to talk about taxes, and it'll kind of round this out. Any other questions? Okay, here's our next slide. Everybody asks me, what taxes do I pay? We talked kind of extensively about how a C corporation is just a flat rate at 21% now. The pass-through entities are taxed at individual rates based on the amount of other income that is on an individual's tax return. So if we're high income, we pay more income. And if we're low income, we pay more tax. And if we're low income, we pay a lower percentage in tax. The issue that we have in a sole proprietorship and a partnership is net profit. There's self-employment tax. Think of it like payroll taxes on people that don't have a W-2. So there's self-employment tax, which is Social Security and Medicare, which is added on to income tax for anybody that has a net profit on a sole proprietorship or their percentage interest in a partnership. If there's no net profit, then there would be no tax. If there is net profit, then there would be tax plus self-employment tax. I'm going to stop because I want to make sure that everybody understands self-employment tax. Do we all know what that means and what that is and why it's expensive?
Would you walk us through that?
Sure. So self-employment tax, here, let's do this one. I'm gonna click off to the next slide because I have a P&L that's just sitting here. Okay, so you can see that the net income in this particular business is 65 grand negative. So this person or these people, depending on whether it's a partnership or whatever, would not be paying any income tax because it's a loss. And now I'm going to go slower because we're going to kind of walk through the way that it would be taxed for each entity, okay? So if, let's say a husband and wife did this and wow, they did great. They had $570,000 worth of revenue, but you can see that highlighted. The depreciation that they were able to take in the first year ran them into negative. Yay. They can take that $65,000 loss if they're a sole proprietorship, a a partnership or an S corporation, that $65,000 would flow through to their personal and would reduce all the rest of their earnings by that $65,000. Okay, so that would be on the loss side. So as long as there's basis, we talked a little bit about that, as long as the people had contributed enough to the company to allow them to take that $65,000 loss, they could take that $65,000 loss and have a nice refund in 2019 in this particular example. If, let's say that these people, okay, sorry, so that's all my pass-through. In a C corporation, the loss would be held on the books until the next year. And then the IRS, you'd look and say, let's say you had a profit. It would net the profit against 80% of a previous year's loss. So let's say that in year 2 or in 2020, this being a C corporation had $65,000 worth of profit. That would be great if you just netted them together and it was zero and we didn't owe anything. That isn't the way that it works. That $65,000 in loss carries forward, but in a year that you have gain, you can only have 80%. So they would take you, being, I'm saying you, but I'm talking about this corporation would pay 20% tax or 21% tax on whatever that is, 20% of 65 grand. Okay, because they get the carryover loss that would eliminate 80% of it, but they'd still have to pay income taxes on 20%. Okay. Hope that makes sense. That's how a loss would work. The reason I highlighted depreciation is because we get a whole bunch of really fun rules since 2018, and they're phasing out, but for right now, they're still the same, that we, if we have an entity, we are able to choose whether we get bonus depreciation, take section 179 or just expense an item, or we say we don't need all this extra depreciation, we are just going to take the normal depreciation over the regular life of the item. So in this particular case, $235,000 was their depreciation because they took bonus on all of the assets that they purchased in 2019. If, however, these people decided, hey, I don't want to take that, they would have $170,000 worth, or 165 roughly, worth of gain. And with $165,000 worth of gain, let's go back to our slide before. Let's talk about how it would be treated. On a Schedule C and also on percentage ownership on a partnership, let's say that we had 50-50 partners. I guess that we'll do C corporate, we'll do Schedule C first. So we have $167,000 worth of profit. And it all flows through to the husband because he doesn't work. His wife works and makes tons of money, and yay for her. And it flows through to on her. The max Social Security for 2019, I think, was $132,000. So the way that self-employment tax works is, and I know you don't actually care, but it's 94.35% of the net profit is taxed at 15.3%. I'll do it one more time. So 94.35% of $165,000 in our example would be subject to self-employment tax, the full thing, Social Security and Medicare. And they'd say, okay, 94.35%, what is that? 150 grand, roughly, okay? 155 grand. So $155,000 is all subject to Social Security and Medicare, and that would be taxed at 15.3% or approximately $22,500. Okay? Half of that would show up as a deduction as the employer's portion of self-employment tax, and it would be a reduction of income. But the tax, and this is why it hurts so much on an income tax return, is that after I do all of my income and expenses and everything else and my credits, then the tax is added on. And so it doesn't get limited or reduced by anything, really. And so it taxed on the end. So we have lots of people go, well, if I'm a sole proprietorship, when should I leave and become an S corporation so I don't have to pay so much in self-employment tax? And that number usually is around, if we're really fastidious people, it's about $30,000. And for people who don't like to pay, who don't want to keep track as well, and need a little more hand holding, and are going to have to pay a little bit more to make sure that their records are good, it's around $50,000. So right around the time that we can run payroll and do all of that stuff, and the self-employment tax savings will cover the cost of the tax return, the additional tax return, cover the cost of the payroll taxes and any kind of administration, minutes, things like that. That is usually right around 50 grand, and that's the time when I tell people, or I recommend, that they move from being a sole proprietor to an S corporation or an LLC taxed as an S corporation. Okay, so self-employment tax is Social Security and Medicare on any net profit. Any net profit that would be above the $132,000 or that limit would only be subject to Medicare tax, and that's a much smaller dollar amount. I think it's 3 point, whatever, you guys know what it is, 1.45 twice 2.9%. So that, did that make sense, or did I do it weird?
Makes sense. I may have some follow-up questions though, Matt.
Okay, so either in a sole proprietorship or a partnership, the taxation and self-employment tax will work exactly the same. When an S corporation has that same $167,000 worth of profit, we're going to use first Austin's example in the person that doesn't take any distributions at all. So I'll ask the question, do I have to pay payroll?
No.
Nope. If I take no distributions, I don't have to pay payroll. If I do take distributions, the first thing that has to come out is payroll. But if I don't take any payroll in Austin's example, and the people just wanted to hold on to that capital, that 167,000 would only be subject to income tax on those individuals' income tax return, and they wouldn't have to pay any other taxes. That would be it. Okay? If, however, those individuals decided, oh, we do want to take some distribution, some pay, something. We're going to take something out. The first thing that would have to come out would be payroll, and we'd go back to our reasonable compensation. We define our reasonable compensation, and then anything above the reasonable compensation, let's say that the reasonable compensation came out to be $60,000. So they had, essentially they pay self-employment tax on just that $60,000 that goes through payroll. The other $105,000 to make our total net profit to be $165,000. That other $105,000 would only be subject to income tax. Did that make sense? Just nod. I can see you. I can see Austin and a girl. Hi, girl. What is your name? It'd be great if everybody tells her name. Go ahead.
Renee.
Renee. Okay. Since I can see both of you, you can nod and tell me whether that makes any sense at all. Okay. That is how income tax will work on the pass-through entities. If the C corporation had $165,000 worth of profit, once again, we can talk about the payroll issue if they decided to take money out. That really boils down to what it looks like on the individual's income tax return. I have a client this year that had a huge loss, or is going to have a huge loss in 2019. We're still waiting to do his taxes. But as such, the corporation, he normally takes a pretty hefty salary, but the corporation, he would rather have all of the, he would rather have the dividend. So with his medium salary on his income tax return, he's going to pay no income tax at all. So what we have opted to do is take a really fat dividend on his C corporation because he will pay 0% for the first $77,000 on top of his loss, which is rather sizable. So he's going to get to take a $200,000 dividend and pay no federal tax at all, just state. So he's very, very excited about that. But so the division between, or the separation between, the corporation's income tax return and the individual's income tax return plays a really nice role when we have a C corporation. The only other benefit that a C corporation really has is the ability to do fringe benefits. Early in my career, I had a company who, as a C corporation, organized specifically because they wanted to provide benefits to lots and lots of family members. And the C corporation did a really good job of providing a retirement plan and health insurance and bike and vision. And I mean, they covered, goodness gracious, they did a really, really great job for themselves and their family by having a C corporation. And a C corporation does that better than anything else, is the fringe benefits. Okay? Have I covered that? Did I do it? Renee, Austin, we got on the profit, net profit, how that's going to work and where I pay tax and how? Okay. I am going to cover my most often asked questions. How do I write off a car? What is the best business structure for my business? What can I write off? Can I write off entertainment? And how do I get the most out of my business tax-wise? All of the answers is it depends on your own personal situation and the structure, like how you want, what you want to have happen matters more than anything. So one of my favorite stories, and I love this one, is I had a client in California. His name is Matt, and Matt came to me early, and he says, I want to be able to write off my beer. And I said, Matt, that's going to be a tall order. Beer is not normally a deductible item, unless you own a brewery, which made us laugh. And then 3 years later, we had found a microbrewery locally, and we got Matt hired on as a taster, and we got him to be able to write off his beer to the company because he was their taster. And he got to try all kinds of exotic beers and do all kinds of and be reimbursed for those expenses as the taster. And I felt like that was such a huge triumph and if you have a long enough runway and you can document and make sure that everything is together like it's supposed to, you can do that. I had another lady that she loved boxers. And so they have a life expectancy of about 7 to 8 years. And so they die a lot. So she had life insurance, health insurance, and some other random crazy expense. She spent about $35,000 a year on her dogs. She goes, I just would love to write these off as dependents. I went, not as dependents because we can't get them Social Security numbers. However, are they security trained? So she goes, no. I said, well, how about we get them security trained? So we went through the process of making sure that all of the dogs that she had were security trained, and that we documented that her three dogs were guard dogs for her home office. And they absolutely were. And I wrote off the percentage of all of that stuff, food and all of those things, the same percentage of the dogs that she used her office as a part of her whole house. And she got audited, and we sent the documentation into the IRS, and we won. So they allowed us to have a $5,000 deduction on dogs every year because she used approximately 1/6 of her home as her home office, and we had them all security trained, and they were, anyway. So it depends. How can I write off my car? It depends. Are we going to do a lease? What kind of business is it? There's so many things that go into all of these, but these are the questions that I get most often. Well, what structure should I be? Because I heard I should be an LLC. So it leads to my last slide. All of these lead to my last slide, which is this. Regardless of what you want to do with taxes, the most important thing is that you have a vision, that you know kind of where you want to go, what your plan is, who you're going to market to, kind of have a decent idea, a rough sketch of what you would like to, what you want the structure to do for you. What are we trying to accomplish? To use my example of the old construction company that had their whole family that worked for it, and they wanted to make sure they were providing benefits. Well, the C corporation was the only choice for them, and it was a great choice, and it worked out great for them. But if they had been a construction company that just hired motivated people that weren't members of their family, then it wouldn't. Then the C corporation probably wouldn't have been the best bet. So anyway, having a vision, have at least 3 heads. Have an advisor, have somebody that you can bounce some ideas off of, and make sure it's not you or your spouse. Those are great people, and you want to make sure that those people are in a room, but it's great to have a 3rd head that doesn't agree with you, so that you can really get to the bottom of things and see things that are, blind spots. So have an attorney, have an accountant, have some person that's been really successful at opening businesses in the past, and include them in your plan. And number 3, don't skip on ads, rent, or accounting. I cannot tell you how often I have conversations with people that are like, oh, well, I didn't want to spend that much on advertising. I didn't get that much out of it. Oh, really? Well, how much did you get out of it? And we go through and track, and they had 100% gain on their advertising. Well, my $5,000 that I spent wasn't worth 10,000 bucks. What? So I know you can't see it, but I want you to imagine like a little drawing on a board, and you have these 3 different advertising buckets, and in one you have 100% gain, one you have 50% gain, and one you have 20% gain. Which advertising do you want? The
100%.
answer, you want all of it, right? You can make money on all of it. And so if I can make 100%, that's great, but I might max that out. And then I do want to do the 50, and I want to make the 20. I want to, if I'm making a return on my advertising, there's no reason to stop. It's only when I spend more than I'm getting out of it, then you can cut that off. So don't skip on advertising. Rent and when I say rent, you want to skip on rent if you do a service, or if COVID sent you home and you could work fine from home, you want rent to be really low. But rent for storefronts and those kinds of things is often a form of advertising. And we just covered that. And accounting, my tagline when I had my own business was, I teach people how to make money on purpose. So that's kind of how we got, how do I make money on purpose at the top? It only failed one time, but to sit down and go over people's books from the start of what does your invoicing look like, where does it come from, all of that kind of stuff, go all the way through their business and get an idea, I could always make myself free. It always cost them less to have me than it did not to have me. So if I can make myself free and we can find more money to do everything else in the business, then yay, then accounting is free. And so that's why I said don't skimp on accounting. And I have found that to be the case in many, many services. Hence Believe, right, Austin? Believe is there for that exact reason, because we can make ourselves free if we eliminate some of the redundancies. Okay, all, you have about, 15 minutes? Shoot, I'm ready for questions. That's it.
Hey Matt, what do you currently do, and kind of what's been your background? And I see 911 worry-free licensing on your profile there.
Yes, 911 worry-free licensing. That is our IT department, and that has nothing to do with what we do. Right now, I work for a company called Certus, and we do taxes and accounting. So I have done taxes for the past 15 years, and I did finance for 5 years before that. That is essentially my working life. I know I look really old, but I've only been working for 20 years.
Hey, I wasn't implying that, so.
It's okay, I understand. the thing that I love the most is the counseling piece. It's always great to find tons and tons of money, but to make a good partnership, a good working relationship, because we can make ourselves free, has always been the thing that thrills me. So when I could do it it was hard to do when I was being a broker in the year 2000. So I made more money in 2000 than I did in 1999. And my customers lost 40–50% that year. And so that was hard to stomach. And it took me 2 more years, 2.5 years to get out, to stop doing that. I always felt kind of like a used car salesman. There's some great advisors. Please don't say that I'm bad mouthing doing that. That was just hard for my heart. Whereas doing things from a consultant standpoint and acting in the realm of taxes and accounting, if I can save you more taxes and you can utilize that money to pay me and put another $10,000, $15,000 into the business to do a better job, yay, that always just felt better to my heart. So I hope that answers your question.
So one question.
Questions here. Go ahead, Austin. Sorry.
What do you find are common expenses or accounting errors that small businesses make that they overlook?
Sales tax is our biggest, probably, even though they attempt to do it right. I get a lot of people who take it out of sales and then put it on their P&L as an expense. So they double dip on sales tax. That's really, really common. Not understanding meals and entertainment is big, and it's relatively new. So any entertainment expense that I paid for my employees is fully deductible. So if I take my employees to the movies, I take them on a boating trip, we go to Vegas for a show, totally deductible. If I do that same thing for me or any of my independent contractors, that is not deductible. That's entertainment, and I don't get to deduct it anymore. That's a common failure or a mistake, because people got so used to what it looked like. Well, I get to write off half. Oh, we have season tickets to the Jazz. That kind of stuff is big, and then documenting it, being able to separate it out and go, oh, well, we have a company trip that goes to the Jazz game twice a year. Is that portion of the Jazz tickets deductible? Yes, it is, and being able to separate that stuff out. The other big issues are the things that the IRS comes out talks to us about. S corporation payroll, so adequate compensation, meals and entertainment, and travel. Those are common. Whoops. If it isn't those things, really, it almost doesn't matter where you put it on the P&L, because it's a legitimate expense. You just, it doesn't matter whether I called it supplies or office. It's deductible the same way. So it's just the things that can be both. But the most fun thing about business is figuring out how to write off something that I really, really enjoy as a business expense, right? That's the whole point. That's why we get into business. So there are as long as we document. So number one is intent. So what was my intent? Well, my intent was to have fun with my kids. Well, then probably sponsoring a race car isn't going to be deductible. But if my intent is for advertising, and even though my kid drives the race car, I can document how much business I've received from said race car. I don't know. I think we're getting closer to the ability to write it off. So it's all kind of the thinking process and making sure we have documentation. And once again, back to the intent. If we can prove the intent and have the documentation to back it up, we've done a good job, and I've won several of those audits. So did that answer your question?
Yeah, no, that's great. One other question I have is, if you are working out of your house as a small business
Yeah.
owner, are there any considerations you need to take into account? So for example, if you have internet at your house, and you're deducting that, or deducting a cell phone, or you buy printer paper, but you use your printer for your business and your personal stuff. Just kind of curious if there's any tips or pointers with those types of expenses.
That is such a great question. So there's a rule for business from the IRS standpoint that says any reasonable and necessary expense, ordinary, reasonable, necessary, most of the time it doesn't get questioned when I have an office. Even if I took a piece of paper and ran home and used it, it wouldn't get questioned. There is a big issue when it's at home. So I'll start with this. If you have a home office, take everything that isn't office out of it and take a picture of it. That's number one. You want to make sure that you have this is my space, it is a defined space, and it has a door, and it's used for nothing else. That's number one rule. Number two, when printers are cheap, I would say that it's very easy for just a couple $100 to buy a devoted business printer that we're not doubling up on. I mean, if budget's I completely understand budget, but when we're really trying to divide those things out and say, oh, well, 50% is used for this and 50% is used for that. If one of my printers, whether it's my home printer or my business printer, has whatever you call it, like a HP or one of those automatic ink, you know what I'm talking about, one of the automatic ink ordering things, and it keeps track of all of the print that I make and all of the ink that I buy, and they provide those kinds of things. It's pretty easy to document that way. Like I know, here, this is my business printer, it's only used for printing for business, and there's my printer for personal, and it's only used for that, and that one has 10,000 copies, and this one has 30,000. It's really easy to say, well, my paper is 3/4 for business and 1/4 for, and you can usually get those reports unless your printer isn't really, really, really inexpensive. That reporting is pretty easy to track. When it comes to cell phone, and internet usage and those kinds of things, it's very difficult to provide exacts, and it's not required. So anything that is reasonable is accepted. The only things that IRS has broken out that said, look, this is what you have to keep track of is those things that I just described, is travel and meals and entertainment. We need to make sure that we've documented those really, really well, and they've split out and said, this is exactly how it has to be documented. So there's no guesswork. But when it comes to, oh, I use my cell phone about 75% of the time. I don't know anybody who goes back to their cell phone bill and their bundled package and goes, oh, well, there were 37% of these phone numbers that I called were for business. Nobody does that. If you have a reasonable amount, say, here's our package, here's my wife is half, I'm half. I have kids, I took my kids off. It's 23% that I use for business. That most of that time it has been. If there is as long as there's a calculation, like a reason, like say, hey, here's I came up with it, and it's reasonable, it'll be accepted. If you ever got audited, and you feel good about going to the temple and stuff, as long as you feel good with you, you're all right. I hope that helped.
Thank you.
Okay, guys, anything else? We got 4 minutes.
I just wanted to know how I get a hold of you if I want to talk to you later.
Oh, I honestly didn't even think of that. Let's do, here, I'll put it on the screen. Let's stop. Let's close this and slideshow. And I'm sharing this screen, so.
What we're doing is to compare Did we get it sold or without discount?
I think we're west, 205 west, 520 north, or Utah, 8407, and you're 385, 557, 7700. My M code is, yeah. You can see that, right?
Oh, now it's bigger?
Yeah,
Can you make it a little bigger?
I can make it really huge. Here we go. Hold on.
Nice.
There we go.
Thank you. Now I can
Sure.
see it.
You are welcome.
Thank you. That's helpful.
Okay. Austin, is there anything else that you want to make sure I cover? Or Renee, is there other little question, or are they all kind of personal questions and it's better to do off group?
Probably mine is more personal.
Okay, fair enough. All right, all. I have an employee that I'm onboarding in 2 minutes, so I am going to go. Thank you all for the time. I hope this was helpful, and thanks, Renee. If you have any questions, now you know how to get a hold of me. Thank
Thank you
you.
very much for your time.
Thank you, Matt.
Pleasure.
Thank you, guys.
Yep.
Been great.